There are two camps in the personal finance world that argue about this constantly. On one side, you have the index fund crowd. Low cost, passive, diversified, set it and forget it. Let the market do the work. On the other side, you have the real estate crowd. Leverage, cash flow, tax advantages, tangible assets you can see and touch and scale. Both sides think the other side is leaving money on the table. Both sides have people who got rich doing it their way. And both sides will show you cherry-picked numbers to prove their point. Today, we're not doing that. Today, we're doing an honest, numbers-based, apples-to-apples comparison of index fund investing versus rental property ownership. We're going to look at returns, risk, time, taxes, leverage, and the lifestyle each one actually requires. And at the end, we're not going to tell you which one is better, because that's the wrong question. We're going to tell you which one is better for you. Let's get into it. Setting the rules. Before we run the numbers, let's set the ground rules, because most comparisons between real estate and index funds are unfair from the start. They compare the gross return on a leveraged real estate investment to the unlevered return on an index fund. That's not apples to apples. That's apples to aircraft carriers. So here's how we're going to do this. We start with $70,000. That's our investable capital, the same amount either way. Option A, we invest that $70,000 into a low-cost index fund, something like VTI, which tracks the entire U.S. stock market, or VOO, which tracks the S&P 500. We add nothing, we touch nothing, we let it compound. Option B, we use that $70,000 as a 20% down payment on a $350,000 rental property. We take out a mortgage for the remaining $280,000. We rent it out and manage it as an investment. Same starting capital, different vehicles, 30-year timeline. Now let's run it. The index fund case. Option A, $70,000 into VTI or VOO. You click buy, you walk away. The S&P 500 has delivered an average annual return of roughly 10% before inflation over the long run. After inflation, that drops to around 7%. We'll use 8% as a reasonable middle ground assumption for a diversified index fund over 30 years. At 8% annually, $70,000 becomes approximately $705,000 in 30 years. That's without adding a single dollar after the initial investment. Just the original $70,000 compounding quietly in the background while you live your life. Now let's talk about what that actually requires from you. You open a brokerage account, you buy the fund, you set up automatic reinvestment of dividends. You do not check it every day. You do not panic sell when the market drops 30%. And it will drop 30% at some point, probably more than once. You hold. That's it. That is the entire job description of an index fund investor. The real estate case. Option B. $70,000 down on a $350,000 rental property. Loan of $280,000 at 7% interest. 30-year fixed mortgage. Now let's build the real picture. Income and expenses both. On a $350,000 property, in a decent rental market, you might charge $2,200 a month in rent. That's $26,400 a year in gross rental income. Now subtract your costs. Mortgage payment, principal and interest, approximately $1,863 a month. Property taxes, $350 a month. Insurance, $150 a month. Maintenance reserves at 1% annually, $292 a month. Property management if you hire someone, which most people eventually do, typically 8 to 10% of gross rent, so roughly $180 to $220 a month. Total monthly expenses, approximately $2,855. Monthly rent, $2,200. That gives you a monthly cash flow of negative $655 in year one. Wait, you're losing money every month? Yes. And this is the part the real estate influencer crowd conveniently leaves out of their highlight reels. In many markets, at today's interest rates, a newly purchased rental property does not cash flow positively from day one. You are subsidizing the property every month, betting on appreciation and principal paydown to make you whole over time. Now, some markets are better than this. Some properties cash flow positively from day one. It depends heavily on where you buy, what you pay, and what you can charge in rent. But at a 7% rate on a median-priced property in most U.S. markets right now, negative or near zero cash flow in the early years is the reality for a lot of investors. So where does the real estate return actually come from? 3 places: appreciation, principal paydown, and tax advantages. Let's look at each one. Where real estate returns actually come from. First, appreciation. U.S. home values have historically appreciated at roughly 3 to 4% per year on average. In hot markets, it's been much higher. In stagnant markets, it's been lower or flat. We'll use 3.5% as our baseline. A $350,000 property appreciating at $3,000 property appreciating at $3,000% after 30 years. Your equity, after paying off the mortgage, is close to that full amount. That's a powerful number. But remember, you had a $280,000 loan you were also paying down over 30 years. And you were potentially subsidizing the property with negative cash flow in the early years. Those costs matter. Second, principal paydown. Every mortgage payment includes a small amount of principal reduction. Over 30 years, you pay off the entire $280,000 loan. That's forced savings, equity that builds whether you think about it or not. Third, tax advantages. This is where real estate genuinely pulls ahead of index funds in one specific area. As a rental property owner, you can deduct mortgage interest, property taxes, insurance, maintenance, and property management fees. And critically, you can depreciate the property over 27.5 years, which creates a paper loss that offsets your rental income even in years when the property is actually profitable. These deductions can significantly reduce your taxable income. For investors in higher tax brackets, this is a real and meaningful advantage that index funds simply don't offer. The 30-year scorecard. All right, let's put the 30-year numbers side by side. Index funds, starting capital, $70,000. Average annual return, 8%. End value, approximately $705,000. Time invested per year, roughly 2 hours. Liquidity, high. You can access any portion within days. Real estate, starting capital, $70,000. Property appreciates from $350,000 to roughly $990,000. Mortgage fully paid off. Equity, approximately $990,000. Plus, you collected rent for 30 years. Though in many scenarios, early negative cash flow and ongoing expenses mean your net cash flow over the full period is modest. Time invested per year, significant. We'll come back to that. On paper, real estate wins on total dollar value in this example. The leverage, using $70,000 to control a $350,000 asset, amplifies the return in a way that a straight index fund investment cannot match. But here's what those numbers don't show. They don't show the 3 months your property sat vacant and you covered the mortgage out of pocket. They don't show the $14,000 roof you replaced in year 11. They don't show the tenant who stopped paying rent and took 4 months and $6,000 in legal fees to evict. They don't show the 200 hours a year you spent managing the property, fielding calls, coordinating repairs, and doing your taxes with a Schedule E. The real estate number is real. But so are those costs. The real difference, time and stress. This is the comparison that the spreadsheets miss entirely. Index fund investing is genuinely passive. You set it up once. You let it run. The only thing required of you is patience and the discipline not to sell when things get scary. Real estate is a business. It looks like an investment from the outside. But once you own a rental property, you are a landlord. You are a property manager. You are a maintenance coordinator. You are an accountant. You are occasionally a collections agent. Even if you hire a property management company, which costs 8 to 10% of gross rent every month, you are still making decisions. You still deal with vacancies, lease renewals, maintenance approvals, insurance claims, and the occasional nightmare situation that no property manager fully insulates you from. That is not an argument against real estate. It's an argument for knowing what you're actually signing up for. If you are a person who wants to build wealth with minimal time and mental energy, someone who has a demanding career, a young family, or simply values their time and attention above all else, index funds are almost certainly the better fit. If you are a person who is genuinely interested in real estate, enjoys the operational side, has time to learn the market, and wants the tax advantages and leverage that property provides, real estate can be an extraordinary wealth builder. The returns are closer than either side wants to admit. The lifestyle difference is enormous. The risk profile. Let's talk about risk, because this comparison isn't complete without it. Index fund risk is market risk. The value of your portfolio will fluctuate, sometimes dramatically. In 2008, the S&P 500 dropped roughly 38% in a single year. In 2020, it dropped 34% in about 5 weeks. If you panic and sell at the bottom, you lock in those losses permanently. But here's the thing about index fund risk. It's diversified. When you own VTI, you own a tiny piece of thousands of companies across dozens of industries. No single company going bankrupt takes you down. And historically, the market has always recovered and gone on to new highs, given enough time. Real estate risk is concentrated risk. You own one asset, in one location, in one market. If that neighborhood declines, if your city loses its major employer, if a new highway goes in next door, if the local school district deteriorates, your asset suffers, and there is no diversification to cushion the blow. Real estate also carries liquidity risk that index funds don't. If you need cash quickly, you cannot sell a bedroom. You either refinance, take out a home equity loan, or sell the entire property, a process that takes months and costs tens of thousands of dollars in transaction fees. And real estate carries leverage risk. The same mortgage that amplifies your gains on the way up amplifies your losses on the way down. If property values drop 20% and you have a 20% down payment, your equity goes to zero. The bank still wants its payment every month, regardless of what the market is doing. Neither risk profile is better. They're just different. And understanding which one you can actually live with, emotionally and financially, matters more than the projected return numbers. The hybrid approach. Here's what the smartest investors I've studied actually do. They don't pick a side. They use both. They build their index fund portfolio first, maxing their 401k, funding their Roth IRA, establishing a taxable brokerage account. They get the compounding running. They get the liquidity build up. And then, once their financial foundation is solid, they add real estate, not as a replacement for their index funds, but as a complement to them, a different asset class with different return drivers, different tax treatment, and different risk characteristics. That diversification, across both stocks and real estate, is actually how most high net worth individuals structure their portfolios, not all in on one side, both working simultaneously in different roles. The index funds provide liquidity, diversification, and truly passive compounding. The real estate provides leverage, cash flow potential, tax advantages, and an inflation hedge. Together, they cover more ground than either one does alone. Which one is right for you? Let's make this practical. Index funds are probably the better starting point if you are early in your wealth building journey and still establishing your financial foundation. If you have a demanding career or life that leaves you with limited time and bandwidth. If you value simplicity and don't want to manage a business on top of your regular life. If you don't have the capital for a meaningful down payment without wiping out your emergency fund. Or if you live in a high-cost market where rental properties don't pencil out at current rates. Real estate is worth serious consideration if you have genuine interest in properties, markets, and the operational side of managing an asset. If you're in a market where rental properties still cash flow positively, or close to it. If you're in a higher income tax bracket, where the depreciation and deduction benefits create meaningful tax savings. If you have the time, capital, and temperament to manage a property, or to effectively oversee a property manager. Or if you want leverage that index funds simply don't offer. And both make sense together, once you have the foundation built and the capital available to diversify across asset classes without compromising your liquidity or your peace of mind. The honest answer. So which one builds wealth faster? Honestly, it depends on the market, the timing, the specific property, your tax situation, your time investment, and a dozen other variables that make a clean, universal answer impossible. What I can tell you is this. A mediocre index fund investor who buys VTI every month, never panic sells, and holds for 30 years will almost certainly retire wealthy. A mediocre real estate investor who buys a property in the wrong market, at the wrong price, with the wrong financing, and underestimates the ongoing costs, will not. Index funds are more forgiving of mistakes. Real estate rewards expertise and punishes ignorance. That asymmetry matters, especially when you're starting out. Here's the bottom line. Index funds and real estate are both legitimate, proven paths to building serious wealth. The debate between them is mostly noise, because the real enemy isn't the wrong investment vehicle. The real enemy is inaction. The real enemy is waiting for the perfect answer before you start. The real enemy is analysis paralysis while your money sits in a savings account earning nothing. Pick a path that matches your capital, your time, your temperament, and your goals. Start there, build the foundation, and once that foundation is solid, consider whether adding the other makes sense. Because the goal was never to win the index funds versus real estate argument. The goal is freedom, and both of these roads, traveled with discipline and patience, can get you there. If you want to see exactly how to get your first $100,000 built, the specific accounts, the specific order, and the exact moves to make right now, that video is up next. I'm Nick. I'll see you in the next one.